I'm Beth Ewan with Franchise Times. We're here at the Restaurant Finance and Development Conference talking with Trey Brown. Trey is the Senior Managing Director at GE Capital Franchise Finance, and he's going to be talking later in the conference about capital markets and the availability of capital for franchise operators and restaurant operators. So let me just ask you, Trey, a big question. What is the state of the capital markets for restaurant operators?
Well, it certainly remains very liquid for those out looking for loans. And as we said last year, I didn't think it could get much more liquid. It potentially has over the last year. So
it really has, huh?
It's a good market to borrow in. For those that have been in this industry for a while, like ourselves, it's a cycle, and it will cycle again. So I think access to capital is good. It's healthy for growth, and the operator should take advantage of it for the right sort of combination of risk and return in their capital structure.
What are you seeing in terms of rates, terms, some of those aspects? I realize that's a general question, but what are those A-level operators able to enjoy maybe that hasn't been the case in the recent past?
Yeah, I think rates and terms vacillate. They're fluid like a lot of the other factors in the industry. I think for the top operators, they're able to negotiate as aggressive terms as they've been able to in quite some time, and rates have been, no secret, very low for quite a bit of time. I think it might be healthy for the overall environment, for the lenders and the operators, for that to balance out a little bit. But in the meantime, I think the best operators will get the best packages in terms of their leverage into the capital structure, and then those new and emerging operators are hopefully getting priced the right way for the same sort of access to liquidity and terms.
What's happening with the M&A market and with debt helping and facilitating those deals?
I think it might have shifted a little bit into the franchisee space. In the past, it's been non-franchise, very active. That leveled off a little bit, but we see a lot of private equity interest in the franchisee, larger operator space over the last year. So net, I think it's about on balance, maybe a little bit off of last year in M&A, but still a very large factor in the growth equation for companies like us to plan against into the out years. So still present.
Yeah, interesting. What do you, at GE Capital, what are you looking for in terms of brands? Are you kind of broadening the brands that you will lend to from what you did in the past, or are you kind of sticking to tried and true in terms of what you've done before?
Yeah, it's as the growth leader for our business, it's a favorite topic. I love new brands. I love looking at them evolve. I love to say I've been on the panel for I think 8 years now, and I love to reference it. In the early years, we did our growth plans through about 6 or 7 brands, and of recent, we've driven growth through as much as 29 brands. So,
is that right?
So it's exciting, especially with the emergence of fast casual and the ongoing entrepreneurial spirit in our industry. You see that evolve, and I think it's great for the industry, and it makes things more healthy and balanced in the competitive environment. So we're actively following and investing in new brands all the time.
Well, thank you so much, Trey Brown, who is with GE Capital Franchise Finance. Enjoy the rest of the conference, and I'm Beth Ewan with Franchise Times.